fifth of a percentage point, but NASDAQ roughly flat. The 10-year note yield at 4.319. Let's get to our panel. CNBC contributor Stephanie Link of Hightower, John Bellows of Western Asset Management, David Kelly of JP Morgan Asset Management, and Greg Ip of the Wall Street Journal. Welcome to all of you. Stephanie, let me begin with you. How close is this Fed to being done raising interest rates, and could this be it?
Yeah, I've been saying for a while that we're in the ninth inning in terms of this rate cycle hike. And I still believe that to be the case. So whether they go, probably not today, whether they go in November or not, I think we're close to the end. That being said, Tyler, the economy continues to have a lot of momentum. We're seeing above trend GDP growth led by the consumer, led by pockets of manufacturing, and that's leading to continued persistent inflation. We've made progress. We went from 9.1% CPI to 3.7 in a year's time. So, but it's not close to where the Fed wants to go. And we know that core PCE number is really what they pay attention to. At 4.2%, it's still much too high. So rates stay higher for longer, and that's what we have to live with.
John Bellows, do you buy that argument? Rates stay higher for longer, but the Fed stays where it is right now. We're near the end of the cycle.
I actually think we're a little bit closer than what Stephanie just said. If you look at the inflation numbers, for instance, on the 3-month basis, they're actually much better than on the 1-year basis. And what that signals is that the more recent progress on inflation has been substantial. I think similarly for growth, we've had a good growth year, but more recently what we've started to see is some cracks in that. Housing starts this week was notable for having a big turn. So I think we're much closer in terms of inflation being closer to target. I think we're closer in terms of seeing some slower growth. As a consequence, I don't think the Fed needs to make much change today. I think you can leave interest rates unchanged and leave their forecasts unchanged because a lot of progress has been made, and that is proceeding carefully today.
Greg, what are you watching?
So, in the old days when I started covering the Fed, in the statement they had something that was called the bias or the balance of risks. And essentially what this was saying was even though we may not have changed rates today, what we're telling you is where we think the likelihood is of moving in the future. And that was in essence talking about whether they were more worried about inflation being a problem or more worried about unemployment being a problem. And essentially for the last few years, the balance of risk has been to tighten further, that all else equal, it was more likely that they would go again, that they would not go. In the last few weeks, I think, starting with Chair Powell's speech at Jackson Hole, we've seen the needle subtly move back towards not quite, but almost to a neutral balance of risks. And I think that what I'm especially looking forward to the press conference for is to hear whether he ratifies the view that rather than being in the position of we're going to raise rates unless the data says otherwise, I'm looking for a comment that effectively says we're going to keep rates where they are unless the data says otherwise.
David Kelly, let's get a quick 20-second thought from you. You expect the Fed to sound hawkish, but maybe act a little more dovish.
Yeah, I don't expect them to raise rates today, but I think you'll see one dot still say, the dots will still say one more hike this year. So I think the messaging will still be cautiously hawkish. I do think they should be done, and I think they probably are done because I do see some softening in the economy here.
That's very interesting. So you think they are done, but they will leave open the possibility of a move up later in the week. We are ready now to go for the Fed decision, and Steve Leisman.
The Federal Reserve maintaining its interest rate at 5.25% to 5.5%. But the committee continues trying to determine the, quote, extent of additional policy firming that may be appropriate. So there's this bias in the statement suggesting they're still looking to raise rates. And indeed, the average Fed forecast does continue to look for one more hike this year with an average forecast of 5.6%. Importantly, and I'll come back to that, there are 2 fewer cuts, 25 basis point cuts built in for next year. On the economy, economic growth was upgraded to solid from moderate. Job growth was said to have slowed, but remained strong. Inflation remains elevated, and the committee repeated its commitment to a 2% inflation target. The average forecast, let's get to the forecast for next year, now sees a 5.1% funds rate next year. That's up from 4.6. So there's the higher for longer we've been talking about all morning here. And just so if you want to do the math with their inflation rate, it's now only a half point of cuts built in compared to a full percentage point next year. The real rate actually goes higher next year. So the average Fed forecast sees itself getting tighter relative to the inflation rate, which remains the same at 2.5. So they have a real rate of 2.6 next year versus 2.3 this year. The funds rate is above neutral, by the way, all the way into 2026. So our first look at 2026, they have a 2.9% funds rate versus their neutral rate of 2.5%. The Fed more than doubled the GDP forecast for this year to 2.1 from 1% of the prior forecast to 1.5% next year from 1.1%. Lowered the unemployment rate for the next several years by about 0.3, so it doesn't see as much unemployment as it previously forecast. And it continues to mention the banking system, but not do very much with it. It says tighter conditions, credit conditions for households could weigh on economic activity, but the extent is uncertain, and it's all unanimous, guys. Tyler?
All right, thank you very much, Steve. Stick around, and as we bring back our panel, and we're also joined by Bob Pisani and Rick Santelli. Let me turn to you, Bob. What is the market reaction here seconds after the Fed releases its report?
Well, here's the effects of higher for longer and a little more hawkish here. So yields up. I see S&P just turned negative. Well, we were up modestly on the day here. And I think everybody wants some confirmation core inflation is turning lower. But what you see here is more hawkish comments on the economy. The economy is growing stronger than they thought. So the GDP revised, it was 1%. The estimate now it's 2.1%. Unemployment was 4.1, now 3.8. So the economy is growing stronger than they thought. That's a little more aggressive, and we're seeing yields spiking up here. I think the fourth quarter is going to be very, very hard to read. Everybody was asking me today about what are they going to say about oil's been up, yields have been up, dollar's been up, resumption of student loan debt. That's what people are talking about down here. So it's going to be very hard to figure out how to call what's going to happen in the fourth quarter because people are expecting the economy to slow down. But you sure didn't see it here from the comments from the Fed overall, guys.
All right, let's go out to Rick Santelli. Rick, what's your spin?
Well, it certainly looks to me like the higher for longer, I would sort of modify a bit. I would say holding here for longer. And that really describes it. And I think the reason they need to hold here for longer is because, like many of us, including the market, sensing some very sticky inflation out there. And I disagree a bit that this is hawkish. Okay, I understand that you had 12 officials that see one more rate hike, 7 that see us on hold. But I also see headlines here that job gains slowed. If there was one thing to say that would be meaningful coming from the Fed, it would be job gains slowed. And if you follow non-farm payrolls or you follow the unemployment rate, it certainly seems as though that is the case. And when it comes to the markets, look at what the 2-year note yield has done. It shot back up to 5.14. Look at what 10s have done, back to 4.36. Why is this important? Many were taking solace in the fact that rates were down a bit today. I don't at all look at it that way. I look at it that the market's been tight, it's been orderly, and it's been rising. And yesterday, as I said on many refrains and choruses today, new cycle high yield closes, 2s, 3s, 5s, 10s, even 7s, except for 7s don't go all the way to 07 because they weren't around in 07. So we want to continue to see what the markets are saying. And why are the markets out of phase with the Fed now? When prior to this, when they were starting to raise rates and Fed funds were more in the 3s and 4% area, market rates were moving down because they really thought inflation would mostly vanish. But the stickiness of certain pockets of inflation, and you could say X, food and energy, but those pockets are glaring and they bring a lot of eyeballs to the Federal Reserve. You could strip it out, but you can't ignore it.
Greg, let me ask you a little bit about the politics of the Fed here, in other words. So what they're saying about next year is very hawkish, right? They've said only 1 or 2 cuts instead of 3 to 4. Their median rate forecast is now 5.1 instead of 4.6%. How much of this is what David Wessel just said, which is that they're afraid of letting the market get too far ahead of itself and getting excited about rate cuts? But do you think they're actually still going to do as many rate cuts as they previously thought was likely?
You really have to heavily discount any projection for what they're going to do more than a few months from here. They actually have no idea what they're going to do. I would say that part of this, I'm going to guess, might have been internal Fed politics. There's a handful of members out there who have been talking about, yeah, they'd like to go one more time because they don't want to take any chances. And maybe the way you mollify them and get the unanimous vote that the Chair Powell got today is saying we're not going to raise rates now, but we're going to tell people that we're not going to cut them as much. Now, when I look at the projections, you see an economy, and this is how he reconciles the very strong growth, very strong labor market that doesn't seem to be responding to the tightening they have to date. He says, okay, we think the economy is going to be stronger than we think. We think unemployment is going to be lower than we think. All else equal, that creates more upward pressure on inflation. How do we respond? We extend the period of monetary restraint for longer. This is essentially the trade-off. We don't need to go higher, but we need to keep our foot at least depressed on the brake for longer to keep the economy from running ahead of its potential.
If we zero in on the last 3 months, though, we're talking about an economy with 2.4% core PCE inflation, adding about 100 and some thousand jobs a month. I mean, that feels to me like a very different picture than the one from 3 or 6 months ago that they might still be responding to.
You could tell two stories about the economy. You could look at the unemployment rate going up, as you know many of us do, and tell us that's an economy that's starting to grow below potential. Or you can look at the GDP numbers, which are what, 3% or plus for the current quarter, well above potential. And by the way, we'll get new revisions on Friday, and maybe the story will look very different. But I think that if you're the Fed, what you say is, even if the inflation numbers are doing what they're supposed to do, they're coming towards 2%, all of our models, all of our muscle memory says that good news on inflation cannot endure if the economy continues to run ahead of capacity. And therefore, we are not going to take a chance on that. And so, well, we don't feel like we have to raise them now and push the economy into recession. But this is an economy that, given the head of steam and the resistance thus far to tightening in train, says we need to basically maintain, again, the degree of restraint for longer than folks thought. And by the way, I think Wall Street might have been slow about this, but the bond market, we've seen 10-year yields moving up for some time.
Yes.
I think in some sense that was just, foreshadowing what the Fed just told us.
Stephanie
today.
Link, let me turn to you. Does this feel to you like a Fed that is close to done with this cycle?
Yeah, I do. I mean, I'm first and foremost, I'm glad that they paused. Not a surprise. They have risen rates 11 times, and plus they're doing QT, and they're going to continue to do QT, which doesn't get enough press in my opinion. So now we wait and we see, and we're now all data dependent. And the dates to keep in mind are on October 11th is the PPI number, and October 12th is the CPI number. Of course, we get the jobs number on the 6th. So we're all going to wait to see on that regard. I also thought it was interesting that they did revise GDP higher, and it's because we are doing better as an economy, much better than what most people expected. A lot of people at the beginning of the year, Tyler, expected us to be in a recession by now, and we're far from it with the Atlanta Fed tracker at 4.9. That number's going to come down, I know it, but at least we're above trend. And then finally, again, a reiteration of the 2% inflation target. He said it a lot at Jackson Hole, and they're recommitting to it again, and they're not going to come off that 2% inflation target. And we have a ways to go in terms of core PCE.
David Kelly, were these the hawkish sounds that you expected to hear out of the Fed?
Yes, they are. But I think we should be careful about this forecast. I completely agree with Greg that they don't know what they're going to do with rates next year. And what I'd say is this is not so much a soft landing forecast. It's really a soft landing scenario. If we have a soft landing, then they will only cut rates twice next year. And I think that is a reasonable forecast. But, I take very seriously the drags that are gathering here. Student loan repayments. I think that higher energy prices, higher gasoline prices drag on the U.S. economy. I think the UAW strike is troublesome. I think the possibility of government shutdown is troublesome. I think the effect of higher interest rates is on the banking system, on lending. All of these things are building pressure on the economy. So even though the third quarter is going to look spectacular in terms of GDP growth, it's going to slow sequentially after that. And I think the Fed is not out of the woods in terms of having a recession in 2024, even though this forecast would suggest no recession in 2024.
Greg, you want to jump in?
Yeah, there's one point I want to make is that we're going to hear from Powell soon when the press conference begins. And as you and I have talked about in the past, he will often sometimes push in the opposite direction of the sentiment that you get from the statement and the projections, right? What I'm going to listen for very carefully is how does he talk about those out-year projections for the federal funds rate? When Chair Powell really wants to drive a point home and he thinks that the SEP, the projections are helping him that, he will align himself. He'll cite the projections. When he actually wants to subtract from that, he'll often say, well, that's not necessarily a promise. It's just a bunch of people putting numbers down. So does he align himself with that more hawkish out-year forecast, or does he play it down? That's what I'm looking for.
John Bellows, jump in here. Your reaction to what's just taken place.
A lot of our conversation has been about growth, and it does seem like the Fed has responded primarily to the better than expected growth. But I wouldn't want to over extrapolate the good growth that we've had. A lot of that has been for kind of very pandemic or post-pandemic specific reasons. There's been a fiscal impulse on top of that, but those aren't things that you can extrapolate forward. So as you try and put your forward thinking on, I do think you need to take into account the lags in monetary policy, the restraint from restrictive monetary policy. And so I wouldn't want to over extrapolate growth. And so when I look at this forecast, both for growth and for interest rates, I'm a little bit concerned they're over extrapolating on the good growth we've had. And if growth slows, which, I think there's a reasonable chance that it will, I think the outcome could be quite different than what they've written down.
Steve?
I am just a little afraid people might be missing a story here. I think the way to think about the Fed is in the context of the real rate and what they're forecasting. And that real rate shows that they are tightening next year. I think this is a recipe for the Fed to be blowing the possibility of a soft landing. Greg is right. They don't know what they're going to do. They don't know what the economic outcomes are going to be. David Kelly could be right in the sense that a lot of these things gathering up could create softness. But the interesting thing to me is the intention of the board at this point to maintain such a high rate while they did not change their inflation outlook. So they are looking at a real rate that is more restrictive next year than it is this year. I don't know if that speaks to their lack of confidence in their ability to bring down inflation or what that speaks to. We may have a chance to ask Chair Powell about that. But the idea of the real rate going up and not going down even a little bit like it was previously forecast, to me is worrisome and something that needs to be watched by markets.
The real rate being the difference between what their expected rate of the federal funds will be next year versus the inflation number.
Right, exactly.
Versus core inflation. And that, not because they expect inflation to go down very much, but it's because they expect rates to stay high, right?
They do expect inflation to go down, and they're not lowering rates as much. I'm curious to know what's behind that, but there is certainly in the forecast a turn towards hawkishness in those forecasts for the outlook for next year.
Very interesting. Very interesting. All right. Thanks to our panel, everybody. We appreciate it. Appreciate your time. And we are, of course, moments away from hearing from Fed Chair Jay Powell himself. And we'll get some more reaction to the decision from former Fed Vice Chair Richard Clarida.
Okay, unmic myself. There you go. So the negative reaction so far, we got the dollar pushing up a little bit. Let me throw the charts on, then we'll come back for the meeting. We got some commentary there. But the negative reaction on the S&P was due to the dot plot, or basically rate cuts being pushed further out. So the market wants to see those rate cuts come in, and rate cuts got pushed further out, right? So that's the negative reaction so far. We have, let me see, let's make sure I can put it on here. You have the dollar. Well, first of all, let's take a look at this. Short rates exploded, right? Big move on short rates. These are the closest to the Fed funds rate when it comes to bond yields. 5-year, okay, up. 10-year up, not too crazy. 30-year, long rates didn't really move, right? What does that tell you? That tells you that there's still going to be some stability for tech stocks, right? In general, if you're just going to get straight to the point. Short rates, not so much, but long duration is not moving. Long duration is saying, yeah, right, you guys can't keep rate. You guys are going to cut in the future, right? Short rates are like, okay, we can't handle that. You guys are signaling that you're going to hold rates higher. You're not going to cut. But long rates don't really care too much. The dollar, on the other hand, moved up. The dollar broke out. I don't want to say it broke out, but it moved right back up to where it was earlier in the session. So the dollar strengthening, obviously, because short rates are up. Oil ain't really doing much. The VIX really, moved. We'll see where the VIX goes. It has some consolidation here. Bond volatility, you always want to keep track on that. You can't really see it here. Let's go to the 1 day really quick. Look at bond volatility. So bond vol up a little bit, right? So the bond market didn't like that. The bond market definitely didn't like that coming in there. And so really it comes down to what Powell's going to say. And the question is, what is he going to say about oil pushing higher? Oil pushing higher. There's some other things you might pay attention to. Let's see, Fed officials median view funds rate. So yeah, they're pushing rate cuts out further into the future. That's what the negative reaction was so far. Bond volatility up. We'll see if we can recover here. By the way, Tesla broke out right before that and pulled back, still holding in here. Let's go to the intraday. And we will get back to the speakers. Tesla holding that level early in the day. A lot of catalysts there. Let's see, pace reducing treasuries. So the real question too is, when they move first, are they going to cut rates first, or are they going to shave the Fed balance sheet? That's the real question. Okay, so they paused. Fibonacci Poppy. So what do you think, man? You thought they were gonna Ace? You thought they were gonna hike right today? Were you surprised that they didn't hike today, Ace? We'll go to the S&P. Let's see. S&P is recovering already. I mean, it's whatever. It's algorithms responding. Not really too much there. It's just algorithms responding. But yeah, dollars up, yields, short yields are up, long yields didn't really move. And that's the story so far. And we will stay tuned. We have like 17 more minutes. We'll let these guys talk. Get back to it.
Between the rate and the inflation rate is actually going to rise next year. What would you say the message is in that?
I think the message is that this is a committee that is probably happy with where they are and where they're projecting, but they do not want to repeat the mistakes of the past of premature mission accomplished, as we saw in the 60s and 70s. And so I think the balance here is reducing rates less rapidly than inflation to keep stance in a relatively restrictive zone with what is a very, very hot and healthy labor market and growth projection on the other side.
How much of a complicating factor is the fiscal spending that our Congress reporter Emily Wilkins just highlighted? You know, just today they're dispersing another $200+ million from the CHIPS Act.
Well, that's right. And I think our expert team here does think that the CHIPS Act and the other legislation will be introduced to the economy over time. So it's not necessarily a big impact in 24. But of course, let's be honest. Fiscal policy has been a big surprise. We've had a big increase in the deficit this year. There's still some accumulated saving from past programs. So fiscal policy, I think, to the Fed is a wild card here, and I think they do need to factor that in.
Talk to us a little bit about employment and jobs and what they said today about it, what the numbers seem to indicate for 2024 and beyond.
That's really what I took note of. You know, the traditional view, and I'll confess I have been in that camp, is that some of the adjustment to disinflate and get inflation down reliably to target is going to require some softening in the labor market. Not a great extent, but some softening. Until today, that was the Fed's view. They had the unemployment rate rising about a point to 4.5.
Right.
In today's projections, the unemployment rate goes up, I think, to 4.1. That's a very great outcome, but that really is a soft landing disinflation. And that is, that's a change from what their thinking has been.
I want to come back to a point that Steve made and actually get Rich's feedback on this. But the fact hey, Rich, how's it going? About the Fed now seeing the real rate somewhat higher over the medium term. In 2025, you have the federal funds rate near 4%, even though you have inflation more or less back to the 2% target, and you have the economy growing at trend and the unemployment rate near its long-term natural rate, right? So, given all that, I almost want to say that 3.9 to 4% funds rate is their view of the long-run funds rate, or what
that's
we
what
like
it
to call
should be.
neutral. But if you look in the same document, they say that their view of the long-run funds rate is still only 2.5, where it's been for years. And by the way, that number is starting to look really stale. If you look at like the long-dated forward curve on the market, it thinks that the neutral rate is more like 3 to 3.5. So I'd like Rich's view on what he thinks is going on here. If the committee is a little bit behind the times in terms of thinking where the neutral rate is, because this has huge implications about where long-term yields are, discount rates are, everything in the financial markets.
Well, and Greg, it has implications for the basic question is policy restrictive? It's only restrictive if it's above some estimate of neutral. So you're absolutely right. I would suspect, now we'll find out in a couple of minutes, I would suspect that if the chair is pressed on that, we may hear him, as we move further into the future to 2025 and 2026, probably downplay the dots in a precise way. We could be surprised. Maybe the message today is as you suggest. You know, my own thinking is, at least at the front end of the curve, when the Fed succeeds in getting inflation down to 2, then the short-term funds rate consistent with those objectives is going to be more or less what we saw before. But obviously, we have to get there first. And part of, I think, what we're seeing both from the Fed and markets is a bit of, I'm from Missouri, you have to show me. And I think that's part of the risk management calculation here as well.
Although, of course, I mean, it either implies they need to be cutting rates by another 1.5 to bring it to what they think is neutral, or that they're going to be running it very restrictive, or like you said, Greg, that they're behind the times. Rich, do you yourself kind of have a view on what's going on with long-term interest rates and which side of this trade you'd be on?
Well, yes. I mean, so I think what we need to do is distinguish between the very front end of the curve, the federal funds rate, and the longer end of the curve, say a 10-year Treasury bond. Historically, there was a positive term premium in the yield curve. Investors got a higher yield in return by taking on interest rate risk. That term premium was essentially squeezed out of markets in the prior decade. And certainly my thinking is, looking ahead, especially given all the government debt that's been issued in the last dozen years, is that we will see a higher term premium and possibly a steeper yield curve. And the way that balances out between the long and the front end, we'll find out. But that's the way it looks to me right now.
Does this all spell soft landing to you, Rich?
Well, it's certainly a Fed that thinks that the baseline is a soft landing. I continue to be in the camp that thinks we're going to probably need to see some additional softening in the labor market beyond what they're showing. But look, this has been a very surprising cycle: the pandemic, the reopening, the recovery, the surge in inflation, and now the rapid disinflation. So I guess the real lesson to take from the last 3 years is, be prepared to be surprised.
What are the fourth quarter potholes that you have your eye on, Rich?
Well, the economy has gotten a lot of support from the ability of households to draw down that $2.5 trillion of excess saving. Again, in the aggregate, we had a period where real disposable income was contracting for about 1.5 years, but households kept spending. So I do think that the ability to keep on chugging along in some sense is more limited than we saw. Also, look, oil prices are a wild card. It's we've been focused on so many other things in the last several months. We've had a big move up in oil on supply decisions. The U.S. economy is different from in the past. It's less exposed to higher oil prices. But again, high oil prices push up headline inflation, and that's obviously a wild card as well.
Rich, thank you so much as always. It's great to see you. Richard Clarida.
Thank you.
And I don't know whether you're staying or you're going. But you're welcome to stay as long as you want. He's staying.
You better stick around, or you were talking to each other. We're just about 6 minutes away from hearing from the Fed chair himself. Jay Powell's press conference begins at 2:30. We'll take you there live as soon as it starts. There's more of our CNBC special, The Fed Decision, after the break.
All right. So, yeah, you got the market now pricing in. Switch this up really quick so you guys can see it. Market is now pricing in the largest, or the biggest probability right now for the market for the rate cuts to come in, right? We're at 5.5 right here, is going to be in July of 2024. So those got pushed out from June. So if you go to June, right, there's a higher probability now in June that they're at the same rate that they hold here. And if we look prior, so if you go to prior, which is 36%, 26. So a week ago, they were pricing in cuts in June. That changed now. Now they're pricing in, they're pulling those cuts further out, or they're pushing the cuts further out. Now it's July. So the first cut is supposed to be in July. Doesn't mean it's supposed to. The probability just went up. So that's all we're looking at here, is pushing out projections. Now, those things can change quickly, right? That can change very quickly. So I don't really think it's that big of a deal. Again, the speech is going to be the most important. What does Powell say? What does he actually say about this oil price moving up? What is he going to say about that? That's more important. Throw your comments in there if you want. We are on YouTube Live if you want to see your comments or watch the screen. All right, so yeah, we got the market recovering, but this is all noise. This is all noise. 2-year yields up, dollars up a little bit, not really much movement. We're going to hear the comments. The market is basically unchanged. If you ask me, the report is good. The drawdown we had was nothing. We've had bigger moves earlier this week on no news. Yeah, there's nothing here. Nothing to see here. They are not in a rush to cut. Yeah, I mean, honestly, it's all data dependent at this point. The feedback loop is pretty quick. So regardless of what the Fed says about the future, it's you're looking at the next month or two. What's going to happen? Are we going to start? Is growth going to roll over? Because listen, if unemployment spikes to 4.1 in the next reading, I mean, the Fed's going to pull those rate cuts are going to come in further. They're going to come right back to where they were because you're getting closer to the economy rolling over to some degree. Jobs, and employment is probably the biggest factor here because everyone says, oh, well, consumer, student loan debt going higher, student loans. I'm sorry, not debt, credit card debt's up, student loan repayment, blah, blah, blah. All that is bull crap. It doesn't matter because people can service the debt. The real question is, can they keep their jobs? If they lose jobs, if the unemployment rate spikes, you can't service the debt. That's where the real issue comes in. I think they're back.
If you want the public to hold twice as much government debt as before, you're going to have to pay them. And so we should not be shocked that real rates are reflecting that. I think it's notable that this first run up, that the latest run up in real rates began with the announcement of the Treasury quarterly refunding, which was much larger than people expected. Is it a disaster? Does it mean 8% inflation interest rates? Does it mean we're going to be Mexico? No, none of that. But the idea that long-term interest rates will be 2.5%, that the real that the real short-term interest rate will be 0 to 0.5 as it was 5 years ago. I don't think that comports with the reality of where we're going with inflation and with government
Which may explain
deficits.
why the 10-year, not that it wasn't before, but it's very sensitive to headlines out of Japan, for instance, or developments there. I mean, any market that has a lot of government debt already, it seems like that's really moving the needle for investors right now.
Right, and Stephanie mentioned we're underplaying QT, and I agree with her. Like for a lot of the last 10 years, who are the biggest buyers of government bonds?
The Fed.
Central banks. Not only are they not buying now, they're selling, okay? So in addition to all the new supply coming out of governments, we have all that other stuff rolling off the central bank balance sheets. That is a lot of debt for the private sector to absorb.
And that means higher interest rates
It's
because
how
you got to
it's-
pay them more.
That's how the market clears.
That's how the market goes.
That's
You
right.
you have to pay more.
You sound like you're from the Tea Party, Greg. I mean, this is the argument for shutting down the government. I guess.
I am not making a judgment one way or the other. We borrow money because we have certain priorities, whether it's the safety net, whether it's war in Ukraine or whatever. But you can't deny the arithmetic economic reality that if we're going to be structurally borrowing more in the future, then that all else equal means real rates have to be
Even
higher.
in a recession, I mean, some people say it's not going to be different this time. Supply never drives things in the long run.
They will come down in a recession, but will we hit the zero lower bound, which is a fancy economist way of saying zero interest rate, and stay there for 7 years again? I really doubt it.
Yeah, I think that was a generational matter. I really do. I think it was a once in a generation.
I think it was a post-financial crisis matter.
Yes.
You remember like the Kenneth Rogoff, Carmen Reinhardt work, all about debts. They always told us that we've been through these crises before, and they take 7 years to basically work their way through. Well, it's been actually about 10, 12 years, right? So a lot of the low rates that we went through in the pre-pandemic period, we're really just working through all the deleveraging post-crisis. It's all gone now.
We've got a few seconds. What are you going to be listening to from Powell?
I think the big thing I'm going to be looking for is where does he put the inflection on where he is with respect to risks. We know that inflation numbers are a bit better than the last time he spoke. The growth numbers are a bit stronger the way he spoke. Which does he worry about more? My gut sense is that he's going to basically ratify the view that unless the numbers go in a very adverse direction, they're done. Secondly, I want to see whether he associates himself with that very hawkish view on rates next year, or whether he
Let's listen to
himself
Mr.
from it.
Powell. Thank you, Greg.
Focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%. Based on the Consumer Price Index, or CPI, and other data, we estimate that total PCE prices rose 3.4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. In light of how far we have come in tightening policy, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a half percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you look at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no. Clearly, what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and then we're seeing progress, and we welcome that. But we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need a policy to be restrictive so that we can get inflation down to target. Okay. And we're going to need that to remain to be the case for some time. So I think, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation really. And what you see are the medians. It's accumulation of individual forecasts from 19 people. And then what you're seeing are the medians. So I wouldn't want to, bestow upon it the idea that that's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting. And so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting or between now and the end of the year. And I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People just stating their positions. And really what people are saying is, let's see how the data come in. We want to see, what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you can make the argument that one hike one way or the other won't matter. But for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be. But we're always going to be learning from data. We've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it as we've gotten closer to it. We've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leishman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell you that to tell us that the committee believes inflation to be more persistent, requires more medicine effectively. And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates. And that's what that meaning is telling you. In terms of what the neutral rate can be, you know, we know it by its works. We only know it by its works, really. We can't, you know, the models and that we use, you ultimately you only know when you get there, and by the way the economy reacts. And again, that's another reason why we're moving carefully now, because, you know, there are lags here. So that it may of course be that the neutral rate has risen. You do see people, you don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that you know, that the neutral rate at this moment is higher than that, and that that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below trend growth to get inflation consistently back to 2%. You kind of get that in 2024 a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment. And that's because we're seeing that rebalancing in other places, in, for example, job openings and in the jobs worker gap. You're also seeing supply side things. So that's happening. I would say, though, I still think, and I think broadly, people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for supply. That's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase, and but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, you know, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path really to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path is narrowed and it's widened. Apparently, ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and you know, I also think. You know, this is why we're in a position to move carefully again, that we will restore price stability. We know that we have to do that, and we know the public depends on us doing that, and we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say, sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policies work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage we're at, though.
But it looks like because there was an across-the-board drop in the core PCE inflation projection for this year, and even then it seems possible that core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina. Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously has said things to the effect of next year, as we see inflation kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply. Is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain. And that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, I mean, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is GDP, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. I mean, to start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other. But we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation. But that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period, much more about that. And the same is true for the others. I don't know if you mentioned shutdown. I think of all of these as being on the list. We don't comment on that. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time. A sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Greg Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth. It'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, a lot better aligning supply with demand. So those two forces were always going to be important. It's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5.6% year-end median Fed funds rate. And since then, you've more than doubled your growth forecast. You lowered your unemployment forecast significantly. So what would justify that last move? Because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected. And that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. We were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But These are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think inflation is coming down? In other words, why did you leave that extra dot in?
Well, I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening, that becomes more equal. And I think the natural common sense thing to do is, as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was the what factors?
The base factors.
Base factors. Okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right. When you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility. Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And, that's what we're looking at. And month by month, what's the reading? And, I think what we're really looking at is there's a tendency to look at, shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. It really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that. And it doesn't, energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware, though, that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So,
Oh, yeah, on the consumer, they're putting more and more of this on their credit card. The consumer seeing, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course, we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully. But at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was the typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks? And how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that will give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You've said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter, rents. And supply is kind of structurally constrained. But in terms of where inflation is going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages. And even if they want to move now, it would be hard because the new mortgage would be so expensive. And that's explaining that's one of the explanations for what's happening broadly in the labor market. Would that play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road, I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, you know, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences, in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up. Whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy has been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. That could be. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth is strong, but I think by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question, your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes. And so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we We want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are, and of course, people with lots of savings also have a much lower marginal propensity to consume, and so they're not going to. It's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
And let me welcome you to Closing Bell. I'm Scott Wapner, live today in San Francisco. That was the Fed chair, of course, following what many describe as a hawkish pause by the central bank. No increase in rates, but the outlook, which the markets were waiting for, shows holding them higher and more restrictive and keeping them longer there than perhaps anticipated. And with that, fewer cuts than the market has priced in for next year as well, perhaps because they also raised their economic outlook for next year, which Chair Powell talked about. He said, quote, the economy remains robust, GDP growth higher than expected, labor market, he says, still tight, but coming more into balance. He also said, this was interesting, at least 5 times, perhaps even more than that they will, quote, proceed carefully, but would raise rates again if necessary. He said, based on the outlook, it was, quote, more likely than not that they'll raise at one of the 2 remaining meetings. Also wouldn't call a soft landing a baseline scenario, but that it was still possible. He did call it the primary objective. Joining me now to discuss all of this and what happens in the markets now is a CNBC exclusive interview. It's Double Line's Jeffrey Gundlach with us as always, as he always is on Fed Day. Jeffrey, welcome. It's good to talk to you today.
Nice to be back again, Scott.
Yep. What's your big
press
takeaway?
Conference today.
Yeah, it
Well,
sure was.
you nailed it.
What is your takeaway from it?
You nailed it with your intro. That's what I was going to say. The word of the day is carefully. He has said it 2 or 3 times in his prepared statement, and he said it many, many times in the Q&A. I think there was something in there for everybody. I think this is really one of the best Fed decisions that we've had in a while. I think that carefully concept is wrapped around the idea that we've raised rates 525 basis points. He pointed that out in his statement. We continue to do QT. With Stephanie Link, I think prior to the Fed decision, I think correctly pointed out, doesn't get enough play, that QT continues to happen. So, they did upgrade the forecasts for next year. Unemployment not as bad, economy a little bit stronger. So I think he's right about all this. I think that it's the right thing to not raise rates. I think it's the right thing to wait. We have a lot of indicators that are looking at softness. A lot of people are making a big deal about the consumer resiliency. I think a lot of that's due to high prices. And you see that in credit card gains. There was a big drawdown a couple months ago, but it's back up. So we see a lot of debt in the economy. And another problem with the economy is there's been so much increase in interest rates for the Federal Reserve and the Treasury Department. In other words, the interest on the debt is really going up a lot. And it's going to go up every month that rates stay at this 5.25 to 5.5 level, and obviously go up faster if they do another hike or two, which they're certainly contemplating or have the door open to. We've already had hundreds of billions of dollars of increased interest expense, and it's going to go up a lot more with these interest rate levels. And it's creating a lot of bond supply. And the bond supply has been one of the reasons interest rates have been going up, in addition with the quantitative tightening. The good news, I guess, on interest rates is at least taxes are going to get paid here in California on October 15th. One of the reasons the deficit is so big is there's been deferral of tax payments. That's going to go away. In fact, it's going to get a lot worse because here in California, we're going to have to pay 2 years worth of taxes unless they change the rules for the 2023 tax payment and push that forward from April 15th. We'll have October 15th, 2023 and April 15th of 2024. That's 2 years worth of taxes paid in 6 months. And I know that some people, are prudent and plan for that. I know I have. But a lot of people, they adjust their lifestyles. And that has to do also with a headwind on the student loan payback, because we know a lot of people, when they weren't paying their student loans, they spent the same amount of money, or they borrowed money, they paid the same amount of interest by ramping up their credit cards. And that's certainly been the case. So we have a lot of cross currents right now in the economy. I kind of see it in a transition. And the data is extremely non-reliable right now because all of this distortions from the government money and now the payback of, and now the drawdown in those excess savings, now the payback of loans. And now we have these strikes showing up. So we have cross currents regarding the inflation situation that it makes it very prudent for the Fed to have a wait and see attitude. These strikes are obviously inflationary. The oil price going up 30% since June is obviously inflationary, right? So all these things are happening, but at the same time, the shelter component of the CPI is definitely coming down. The owner's equivalent rent lags badly. If you look at the Zillow and apartment list rent roll indices, they lead the owner's equivalent rent or the shelter component by about a year, and they're basically flat year over year. So a lot of cross currents going on, and it's absolutely appropriate to wait and see for the data. So they did the right thing.
Chair Powell said, based on the outlook, that it was, quote, more likely than not, as I've already said, that they'll raise at one of the two remaining meetings. You made the case repeatedly recently, including just last week, a few hundred miles down the coast from here with me, that you thought the Fed's done. Do you still maintain that view that they are finished raising interest rates?
I think the probability of rate hikes is higher than what I thought before this oil spike happened. The oil spike is really going to be problematic. We already know that the base effects, the roll-off of the CPI is going to lead to very likely inflation going back up, kind of staying where it is now in a sticky way, maybe even going to a 4 handle on the headline CPI before it comes down with that shelter component effect. And so I think the chance of a rate hike is higher because these oil prices are going to be a real problem. My gasoline station over the past few months, the price has gone. I get Supreme gas, 91 octane. It's gone from $5.50 to $7 a gallon already in just the past few weeks, and that's not going to go down with West Texas Intermediate above 90. So those things lead to a little bit of a headwind against the idea that the Fed can cut rates or stay on hold. And I think that's appropriate that the Fed sort of downgraded the so-called rate cuts because of this these cross currents of inflation. So I do think there's a better probability that we'll get a rate hike than I thought, say, 2 months ago.
Steve Leisman, of course, was in the room, asked a question to the chair, as he always does. He's stepped out now. and is going to join our conversation. You know, Steve, I want to hone in on an issue that you raised earlier, and a point that you underscored in your question with the chair, as asking why a more restrictive real rate next year than this, to which he was explicit, where he said, because of the stronger economy. And I just want your perspective, because what I feel is now interesting to talk about is it seems to me that the chair's biggest problem now is not where inflation is, it's where the economy is. And he is afraid that because the economy is, as he said, much stronger than they thought it would be, that inflation is going to come back. He doesn't trust necessarily that it's going to remain on the trajectory that it's been.
Yeah, I mean, Scott, let me just point out from the Vulcan mind melding department that is the exact quote that I brought to you here, was his answer to that question. So I'm going to let Chair Powell say what he said and answer the question. And if you don't mind, I'll comment on the back end of that.
Rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity.
Now, just to understand what he was answering, the question is, he even surprised me. I was on Scott's show earlier today saying, I think higher for longer is going to be what we're going to hear today. But it surprised me that from a real rate perspective, take the Fed's inflation forecast, take their funds rate forecast for next year, the Fed becomes relatively more restrictive next year. I thought maybe it would pivot a little bit higher, but in fact, what happened is they kept the inflation rate the same, but they added a half a point or took away a half a point of rate cuts that they had previously penciled in. And Scott is right. I think the stronger economic growth is part of it. I think there's also a persistence to the service side of inflation that may be a part of it. But look, here's the thing. Even though the forecast, Scott, is one that is relatively more hawkish, the overall forecast is more bullish when it comes to GDP, when it comes to unemployment. And I think I take Powell at his word that he's going to be careful in getting there. Just because you have a plan, even sometimes, Scott, if that plan is a little reckless, doesn't mean they're going to execute it. So the idea that they're going more slowly should give you a little comfort, even if the direction of travel is one that is ultimately more hawkish.
I was going to ask you that, too. The idea of those words, proceed carefully. As I noted at the outset, I counted at least 5. It's probably a couple more. Jeffrey himself raised it very much at the top. Do you want to just opine on that? Why he felt it so necessary to underscore those words?
Well, I think the reason is because, look, he did an awful lot of work. 500 basis points is a very historically aggressive rate hike cycle. He's gotten through it to a point where there's not obviously going to be a recession at this point. He has a chance to stick a soft landing, and he now has the luxury to take a little bit more time. I think the idea of a pause this month made a lot of sense. It may be they pause again. In fact, Scott, if you look at the probabilities, I'm sorry, I haven't looked at it since I came out of, since the 2 o'clock announcement, but it was higher for December. So they pushed it ahead. They said, so you know what? I think November is likely to be a pause. And it's not even at the 50%. So Jeff could be exactly right. They are done with somewhat higher probabilities that they're not. But the odds on call right now is that they are done. And the focus now is this: how high for how long? Today we learned longer. But I think Powell's also saying, you know what? If I don't have to be, maybe I will take some back.
Yeah, good stuff. Steve, I appreciate it very much. That's Steve Leisman, our senior economics reporter down in Washington on the backside of the Fed Chair's news conference. Back to Jeffrey Gundlach, who's clearly still with us, too. Jeffrey, your reaction to that, what Steve Leisman had to say about, the economy being sort of, this too strong economy in some respects being an issue for the Fed Chair?
He really bought himself some time in a very clever way, Jay Powell did, I think. He basically said we're mindful of economic strength that, like GDP now it's pretty high at the Atlanta Fed. It's got downgraded recently, but it's still, I think, in the 4s, maybe the high 4s. So it's a hat tip to that. They do the clever thing of buying themselves time. They make a forecast for, the future, 6 months from now, 18 months from now, and they leave rates unchanged because they're cognizant, rightly so, of the potential for all of the accumulation of this tightening between the 525 on the Fed funds rate and the quantitative tightening to date. I'm going to go back to the old shadow Fed statistics, where there was a study done where they said if we didn't do this quantitative easing, quantitative tightening, if all we did to manipulate monetary conditions and looseness and tightening was the Fed funds rate, where would the Fed funds rate have to be to equate to the Fed funds rate tightening of 525 plus the QT? So if we didn't do the QT, this study shows that they've raised rates, they would have had to raise the Fed funds rate by 730 basis points is what they've effectively raised the Fed funds rate. That's a lot of tightening. And the Fed needs to realize, and of course, Jay Powell said so explicitly, that the QT is continuing. So those rate hikes really are not rate hikes, but it's tightening of monetary conditions. That's going to go up to 800 basis points. So it's very clever to say we're respecting the potential for less of an increase in the unemployment rate, but at the same time, we are going to buy ourselves time. Really good stuff. I think it was an excellent way to handle this meeting. I agree with Steve completely that I think the narrative is going to develop that there's going to be no rate hike in November because they need more data. They need more data, maybe December. But the other thing I want to tell the listeners about, this is really an interesting thing. I always talk about the yield curve being inverted as a warning signal, if you will, puts you on watch that a recession might be coming, but it doesn't happen imminently. It takes time. And so it's usually about 14 months to maybe 18 months after the 2s, 10s inverts that you start getting a recession. Well, that was last October, so we're coming on a year on that one. And one way to track this, the best way, one of my investors sent me a note the other day that I found very interesting. Just look at the 30-week moving average of the 2s, 10s spread. When the yield curve de-inverts by crossing back above its 30-week moving average, that's a really strong signal of a recession. And that's very close to happening. Also, the unemployment rate is now up by 40 basis points off of its low. It's probably going to go higher, in my opinion. And so with that, you're going to get a crossover on the unemployment rate. And also, the unemployment rate is going to cross over its 3-year moving average in the first quarter of next year by our assessment. These are really strong recessionary indicators. So it's starting to pile up. I think that the problem that we have, government shutdown looming, student loans being paid back, taxes being paid, I think the economy could slow down fairly quickly once we get in the next, say, 4 to 6 months.
But all that said, did bonds just become more attractive today? Because we think that, especially on the short end, you see that the 2-year is obviously up. Stocks, by the way, are at the lows of the session at this very moment. But if we think that, rates on the short end are going to continue to rise for a bit before perhaps, if your projection comes true and the economy weakens and then theoretically rates would go down, did bonds just get more attractive to you?
I think Treasury bonds are attractive. I find them quite attractive at this moment. Not for the long term, though, Judge. It's really for the short term on economic gyrations, which I think are going to be weaker economy and probably weaker inflation than people are forecasting. But the problem is the long term for interest rates is getting increasingly unattractive because we have all of this interest expense that's piling up. And the deficit's already at 8% of GDP. And under a certain scenario that's not a very pretty one, you could.
All right, let's wrap it up. Let's go ahead and wrap it up. What do we see here? What's going on? We'll go through the highlights. Let's see. All right, yeah, let's go through the highlights here. And then we'll wrap it up. So make sure we're working here. Yep. All right. So what Powell said the same thing as usual. I think the biggest thing that we said is that we're looking for is oil. What was he going to say about the oil price, right? The spike in oil. That was the most important thing. And he kind of shrugged it off. He kind of said, we're not too worried about it yet because it's too volatile. So I think with his words, what he's saying is oil is volatile. The higher that oil goes, the more it constrains consumers, the more it tightens conditions. And we're already kind of, we already have to operate very cautiously. So the closer that oil, the longer the oil sticks up there, it actually, CPI is going to be up, but it's also going to crush the economy to some degree, right? You get student loan repayments. I don't think it's a big pull, but when you add that to oil prices, when you add that to people paying their taxes, when you add that to retail slowing down, you get a slowing the economy, right? Unemployment ticks up. So that's going to make them more dovish. So the market's going to have to figure out, are they going to hike in November, right? And is the economy going to slow down? So keep your eye on EPS, right? Your earning estimates for the S&P. I think you're going to see a separation from big tech versus value stocks, because value stocks have a lot to do with consumer spending. They're going to slow down. But B2B businesses, right? Tesla, Amazon, Google, Facebook, Amazon's coming, they're going to keep going higher because they get the government spend. They're going to get the Inflation Reduction Act, the CHIPS Act, the infrastructure bill, which is going to provide more jobs. So maybe we do see unemployment spike. I don't want to say spike, but move to 4% because it is lagging. But that also keeps the Fed on pause. I think they're done here, just given listening to what Powell is saying. So again, coming back to oil, what is he also saying? He's saying that, okay, yeah, oil's up. We focus on core. Specifically, we see shelter making progress, right? Shelter's coming down. The jobs market is doing what we want. That's exactly what we wanted. That's good. So the other part that's lagging is, okay, more members, more members obviously want to see another hike in November because the GDP numbers have been coming out stronger than expected. But we do know Atlanta Fed GDP got revised down for the first time. It's been going up, up, up. Now it's getting revised down. So as the data comes in, data dependence, we should witness the GDP forecast still maybe fall a little bit, right? And that's going to decrease the chances of that November hike. That is going to decrease that chance. If oil sticks up here, decreases the hikes. If oil comes down, I don't think oil is a big deal immediately, unless it spikes. It is pulling back a little bit. But I don't think it's that big of a deal at 90, right? 92. Once you get to 100, that's going to come onto the table for the market. The market's going to have to address that for sure. And it's a tricky situation. So I think the big takeaway here is that the Fed's going to have to pause. Core is making progress. The Fed's going to have to pause. Headline might be up a little more. And I would just keep my eye on liquidity. Powell he said cautiously 5 or 6 times. So I think he's anticipating something could break here. And if it does, more Fed liquidity. And he's also saying, hey, the Fed balance sheet is still being shaved off, which means we're still pulling liquidity out of the market. Treasury issuance is still going out there. So what does that also, that means we're still tightening. So they're still tight. The pressure's on. I think they're done here. And they can just hold rates and see what happens with the economy. The households were stronger than expected, right? Households were stronger than expected. Oh, savings are bad. Well, savings rate, maybe not, because people are moving their money from their savings accounts into money market funds, which counts as an investment. So possibly that's why. So consumers are still healthy, and he wants to get inflation down. It is coming down to some degree. It's all in energy. And I think the takeaway here is that with all these piled together, it's actually pushing them towards a pause. It's pushing the economy to slow further than expected. So as an investment vehicle, you have to ask yourself, who's going to benefit from higher energy? It's not going to be consumer spending stocks. It's going to be energy stocks and stocks who have nothing to do with that, like tech in general, right? So that's the conclusion I got of it. I will put together a report. It'll be in the newsletter, free newsletter, link in the description if you want to get basically a review of everything that was, that I got from this meeting. See if we missed anything else. And then moving over to the market reacted pretty negative at the end there because he became pretty hawkish. The VIX is up. Let's take a look at these technicals really quick. You can at least see how the market is reaction. I think it's very important to see how the market's reacting, not just, what he said, but what's going on here. And I was looking at liquidity, how it changed. So the VIX is starting to pick up a little bit. It's nothing crazy. It's at 14.6. If you get a VIX above 15 and hold, there could be maybe the market is pricing in, because Powell did say a soft landing is no longer the base case. Very dovish for the market. Soft landing no longer the base case. And he also said that stronger than expected data, not strong data, stronger than expected data could cause us to do more. I think he's full of crap, because I think it's more likely that things are actually slowing in this case. You go to 2-year, this is not good. 2-year breaking out. The market is going to, this is a bear steepener, meaning your short-term rates are going up again. And if that is the case, on a pause, this shouldn't have happened. On a pause, the 2-year is going up. 10-year isn't moving much. The 30-year isn't 30-year came down. So this is positive for risk assets, which is why I think riskier assets like tech can still do well because their rates are out into the future are not moving up. They're not getting tightened on. They're not tightening, but 2 years moving up. And then you move to the dollar. Well, is the dollar going to tighten? First it sold off. Now it's going up. So what we're going to see over the next couple of days, how the market digests, how the bond market, how the equity market digests the tone of the Fed here. And, oil is pulling back a bit, right? Oil is pulling back a bit. And if this comes down, that's going to ease conditions. If it goes up, it's going to tighten conditions. So either way for oil, if oil comes down, I'm sorry, inflation expectations come down. If oil goes up, recession expectations go up. So that is the issue with oil. You get oil spike, recession implications go up, and you might see some stagflation. And if it comes down, that'll be good for the market. So that's what you're expecting here. Will the pause come forward? I think that's all we have so far. Yeah, we'll be on it tomorrow. We'll be on tomorrow again to check to see how the market reacts here. So again, very hawkish pause here. Do we have any comments? I just saw that. Think he's done their talk with oil produced by. I'm sorry, man. You got to give a complete sentence. I think you're saying, I think he's done? They're in talks with oil to produce more by opening close refineries that were closed. Sure, but that's not going to impact oil right away. It's going to come down to, I think oil can't surge much further because the supply is going to start meeting the demand here. Remember, the U.S. is at a 3-year high for supply in oil, right? Because this is the big risk here. It may not move the Fed, but it's going to move the market. So supply in the U.S. not all time high, 3-year high, getting back to pre-pandemic levels. There's 2 OPEC countries who do not have to cut supply. They're still producing. Venezuela is still producing. Nigeria is still producing. There's 5 other countries still producing high oil. So I don't think oil can really surge. I could be wrong, right? Maybe there's a breakout. People are still trading it. We got to keep our eye on oil. It is overbought. After this meeting, it doesn't really change oil at all. And if the U.S. economy does slow down from all this, oil can't keep up. The supply is going to meet with that. So I'm thinking upper level, we get to 95 over the next, maybe we get to 100 next year. Who knows? We get to 95. Maybe we press 100 at the end of this month or over the next couple months. But by the next Fed meeting, that is the question. We know CPI is going to come in hotter than expected, or hot because oil surged. But core is the focus here. And this is where I'm still positive. Liquidity is still coming into the market, right? The market is selling off, but I want to see this after the meeting because I want to see support come in. I want to see where the buyers step in. If they can't hold the level is about what, 440, 431 is the lower level for the S&P. Let me see, S&P is 431, but you're looking at a retest of about 435, which was after Jackson Hole. We'll see. We're at a critical level right now. So there's a lot of uncertainty. The market is very bearish, but if you take a look back, we're just wedging. The market is in a wedge pattern, still in the uptrend, and shelter is coming down. That's the big one that's going to factor in. He said, housing prices, or at least rent prices, new leases are starting to reprice lower, which we said a while back that's going to happen. Yes, gasoline prices are up. Nat gas is still low. So natural gas is still, electricity, energy prices still low. It just comes up to oil pushing it up, right? And then the jobs market, job openings are still falling, right? The UAW strike, some people say, Jeffrey Gundlach said that's inflationary. It could be on the supply chain, but they're also laying off workers because there's no reason to have them. So that also could make unemployment go up at the same time. Sounds like a very bad disaster, which is why the Fed is cautious right now. We could get an inflationary, there's no systemic inflationary, headwinds, but there are short-term headwinds for inflation, oil, possibly supply chains in the car industry down a little bit, automotive industry, which gives more, credence to Tesla doing better. So I think you have a bull market somewhere, right? Oil's still going to be up. Remember, as long as oil's up, those energy producers, their earnings are going to come out better, raising S&P estimates. So the reason I'm bullish is liquidity is still coming into the market. Yes, short-term rates are up, long-term rates are down, which means tech stocks can still move higher here because they don't so much depend on consumer spending as much as they do B2B, business to business, and also at the same time, there's a lot of innovation there. And then the biggest factor, fiscal policy in the fourth quarter coming, right? Fiscal policy. What'd you say? Can you say the letter N? Fiscal policy coming in the fourth quarter. So what does that really signal? Well, there's going to be more growth to come. And I think that's why he's cautious here, right? There's more growth to come. Inflation Reduction Act, like I said 1,000 times. So, the market's probably the probabilistic outcome after this meeting, which means nothing. We got to see how the market trades over the next couple days. 431 is your low on the SPY, right? 431, or if you're looking at SPX, 43.25. 43.25 is your low. Okay. Crypto has some catalysts coming into the market. But overall, it was it was a hawkish pause, but we're pretty sure the Fed is done here. I don't know what you're saying there, Aguilar Vapor. So that's all we got. Let's check back in tomorrow. I can take this no more. I'm about to buy Amazon calls. How does Amazon look? Take a look at Amazon. Yeah, Amazon pulling back. I mean, I think there's going to be opportunity for big tech. And those Fed fund futures, I mean, the market is still anticipating the largest chance of a cut in July. That did change. So we're looking at July for the cut. We're looking at a pause right now. All right. Put to call ratios. There's a lot of puts got bought today. A lot more puts. Not changing the trend too much. Volatility still down. And so, yeah, we're going to check on, we want to see how the market moves over the next couple of days. KRE, I wanted to double check, is KRE rolling over after that? KRE is making new lows. So this is going to be something to look at. KRE, the regional banks, if they keep collapsing, the Fed says that they're tightening the Fed says they're tightening the financial conditions with the balance sheet, but we know last time that KRE fell apart, the Fed stepped in with the bank term funding program. So again, you're going to have some volatility in the market over the next month or two. I think we trend up because usually when the Fed pauses, it's not as bad as everybody expects. More people there's a lot of fund managers still in cash. Do we buy treasuries? Well, not when the economy is too strong. Okay, everybody's looking for the tip over point. The economy is in perfect conditions to stay bullish for stocks. Why? Because growth is cooling, but it's not negative yet. You have to say, okay, well, if it's going to go negative, you need a black swan. It's not going to go negative. Household balance sheets are fine. Consumer spending is still pretty well. B2B business investment is still up. So, inflation is down on the core side. So the Fed has to pause somewhere around here. They've already paused. We got the pause. Now it's okay to the rate hike in November. And liquidity at the RRP is picking up. Okay, liquidity is still picking up at the RRP, eating up those treasuries. Maybe they're eating long end treasuries because the long end isn't moving. And then maybe the short end is where they're giving up. I don't know. So biggest risk right now, oil keeps surging, short-term rates break out, which is actually happening right now. Short-term rates are breaking out, and we'll see if somebody steps in to buy that. That's all I got. We'll check back in tomorrow. You guys have a good day. Stay blessed, and we'll be ready to tackle the markets and digest everything that the Fed has to say. All right, you guys stay blessed. Catch you tomorrow.